Good morning. It is Friday, April 5th, 10 in the morning Central, 11 a.m. Eastern. I don't know. It's like 2 in the morning in India. And what would it be? I don't know, 9 a.m. in the mountains, except in Arizona. I don't know. I have to put up a chart for that. Today we're going to talk about the unemployment report and some of the implications, because they're important implications. And I think that most people are getting it wrong. I am going to make a point of ripping on some of the CNBC folks because, you know, that's great fun. And seeing as they don't invite me on, I mean, why not take a couple shots at them? Hopefully they decide they want to argue, and then I can tell them how wrong they are on air. All right, so got the jobs report this morning. It was pretty good. 196,000 new jobs, and 182,000 of those were private, 14,000 government. I'm not sure why we're adding government jobs. Most of those are local and state level jobs. So if you are living somewhere where they are hiring local government employees, I think as a taxpayer, at a minimum, you should ask why. Because right now the economy is a little bit fat, and adding government jobs probably doesn't make sense unless there really is a need. And I'm not so sure that there's a need to be adding government employees right now. That is a little bit stimulative to the economy, but it also costs money. And I'm not too sure that we're not making the same mistakes as the past and living a little bit high on the hog there. So keep an eye on your local politicians. Make them at least answer the question why they're hiring government employees. I'm not saying that there shouldn't ever be government employees getting hired, but I'm not so sure that at this point in the cycle, it makes a lot of sense for your local governments to be increasing expenses at a time when we know that revenues are probably peaking out. And that means that when we get a recession, they're just going to jack your mill rate on your property tax or your income tax or your sales tax, however you get taxed in your jurisdiction. You know, most of the country, it's property tax. So we are seeing some interesting things with the labor trends, and I am 3/4 of the way done with an article that will go up on FA Trader as well as behind the paywall at my other sites. But take a look here. Here's some of what the jobs numbers tell us. So here's a quick recap. Payrolls rose 196,000, a shade above the 177 consensus estimate. Consensus. My water did not go down well there. And we already covered the private employment to government. The automotive sector announced 8,800 planned job cuts, bringing the yearly total to almost 16,000. And then energy, over 8,000 cuts, bringing the total to probably going to be 11,000 sometime this week or next week. Unemployment rate remained at 3.8%. Labor participation fell just a hair. The underemployment rate, those who would prefer to be full-time but are part-time, remained at 7.3%. The average work week rebounded from February, and February had fallen 0.1%, and now it got that back. So that's positive, because that's basically added jobs. It's not that people are actually working more, it's that the more people are working, a little bit more. So that's good. Wages have risen 3.2% over the past year, but gains have slowed in recent months. So if we know that inflation is 1.5% to 2%, that means that people have gotten a whopping 1 to 1.5% increase in wages in the last year, whopping 1.5 to 2%. So that's kind of negative, actually, but it is in line with the trend that we have seen for almost 40 years now. So in the last 40 years, inflation adjusted, if you're in the other 99%, you really haven't seen much of a increase in wages, but you probably have seen an increase in standard of living just because of the things that technology has done. So an unemployment rate of under 4%, typically considered full employment. Back when the labor participation rate was higher, economists would tell you 5%. So when I was in school back in the late 80s, early 90s, they said 5% was full employment, but we had higher labor participation. Since then, that number has come down to about 4% because we have lower labor participation, which means less SLAQ. So, we will see how that goes forward, and we'll talk about labor participation in just a second because it's a lot of fun, and I get to reference the idiocy of Rick Santelli. So, U6, which includes the part-timers who want to be full-time, has dropped, so that's good. And you can see on this chart how that is done since it peaked out after the Great Recession, and is now about normal. It could go down another point or so, but probably not much more. And so we're getting close on a lot of these things to being at full, to indicating full employment. On the surface, that's all very impressive, but labor force participation rate stands at 63%, which is far below the historical highs, though probably within 1 or 2% of what is feasible. And what does that mean? So, during the time when the baby boomers were doing the dual income thing and moving towards their peak income years, we had labor participation get all the way up to about 67 and change percent. That's this period right here. Today, we're down at about 63%, right? What is this gap here? So why is there a gap here, and why is there a gap here from what seems to be the normal level? The normal level seems here. This is the rise of dual income households, plateaued, shot up again during the boomer big money years, when they were all working, and then came back down. We should probably get to about this level again, but we're pretty close. So 64, maybe 65%. And what is the group that is keeping this gap in place? It's about 1 million, almost 1 million, millennial men that are underemployed. Your so-called basement millennials. So if you added about 1 million people here, now all of a sudden you're closing into probably what is going to be the high point on labor participation. Now, if you are a Rick Santelli guy, I'm just going to tell you, stop listening to the guy because he's just a trader who tries to justify his views. And the reality is that he's just not very good at it, but he yells a lot, and he's good for CNBC. I'm not saying I'm not that much of a hater. He's a good Italian guy. He works hard, but he just doesn't understand some of the economics. He gets the markets. I will tell you, I think he's a really good trader. He gets the markets and how things move back and forth. But for him to turn around and explain some of these things economically, he just shows an exorbitant amount of idiocy. I've heard him say that, we need to get 100 million more people working. That is so stupid and ignorant that I don't even know how to make that statement stronger. We have 320, 30 million people in the country, and you have an awful lot of people who are over 70, and an awful lot of people who are under 17, and an awful lot of people who are disabled. There's not 100 million more people that can work, right? Even if every household was a dual income household, and every individual who was able bodied worked from 18 to 65. You know, there's not 100 million jobs from here to 100%, right? And this is that's that group, you know, employable. So, not retired, not a kid, not disabled. So when you hear numbers like this, if you're one of those guys in the bar or wherever or online who are talking about, oh, we got to get 100 million more jobs, you're out of your mind. So, you know, I'm not going to pull any punches on that. I've been listening to this garbage for about 7 or 8 years now, and it is stupid, it is ignorant, and it should be ignored. And if you're suffering from this malady, fix it. Now, on the other side, CNBC's Yell Fest, you've got Steve Leisman, and I hope that's how you spell his name. I didn't mean for it to say Leisman, but maybe that is how you spell it. I will spell check that. Ooh, maybe an extra N. I don't know. He says that labor participation rate is lower because of demographics. Sort of right, but he doesn't explain why very well, and I don't think he knows why. He implies that this labor participation rate is down because the boomers are leaving the workforce. No, as baby boomers get older, they come out of the workforce naturally on this chart because there's an age limit. So that's not it. It is the younger people who aren't working. So ignore Leisman too. He's being lazy, frankly. And if you pay attention to him the last decade, you will notice that he has gotten pretty lazy. You know, but he argues with Santelli, and they like that. So, in any case, the millennial men who are not working, if they get back into the labor force, should drive labor force participation back to 64, 65%. We're probably not getting to 67% again unless we start getting more dual income households. And maybe we will. But I think the choices that are getting made by folks who are having children are pretty obvious. I think that with the cost of childcare, unless you are making $25, $30, $35 an hour, you might as well not work. You might as well get a part-time job and keep your kids at home, because the cost of childcare is crazy high. My brother pays like $800 a week or something. I mean, it's just mind-blowing how expensive childcare is. So, you know, I think that goes to a couple percent of the people out there at least. Because wages have gone up lately in the last 3 years. And you know, there is some rise under Obama, and then in the last year under Trump, which is great. I would love to see those numbers going up a little bit more than they are, 4-ish, 5-ish% a year. We could handle that for a while because there's just a lot of catching up to be done. So theoretically, wage inflation is supposed to happen when employment gets tight, but it really hasn't happened. And I don't think the economists give good answers because they're steeped in their theories. Well, I would offer this. The destruction of labor rights to collective bargaining that's been happening since the early 1980s, really not much you can rip on unions anymore because they barely exist, has had a direct correlation on wage increases. Now, that's been good for the corporations, right? The corporations make more money now. However, we've had stagnating wages, and that has, you know, stunted wealth creation and really created a more bifurcated society where you have people who are doing pretty good and people who are hanging on, and there's not this successful middle class anymore that, you know, used to be over half of the population. Now it's really shrunk down. So, you know, that's something that we're going to have to deal with. and hopefully, you've heard me talk about AOC. Hopefully we don't snap so far left that we just break things a different way. But the employers have been able to very effectively use the threat of layoff or moving jobs to keep people from even asking for a raise, right? Because they're afraid if they ask for a raise and get it, then they're going to be next on a chopping block. Millennials, I think, have shown a propensity to ask for more raises, but that's largely because they're very willing to switch jobs. In their mind, they're not staying somewhere for 30, 35 years, as opposed to the boomers who really hoped for that, and the Xers who I think is a coin flip horse piece on that. But millennials, they're willing to switch jobs. So, excluding that almost 1 million that don't work in the millennial men market, which it makes dating women their age a little easier if you're into that sort of thing, because there's a lot of losers in the millennial men, and it's not a majority. I hate to rip on them nonstop, but there's that group. Just single out that group. Otherwise, I'm genuinely impressed with the millennials, and then they are willing to switch jobs to get what they want, and I think that they accept and even expect that that's just the way it's going to be, and that's a social change. It's been very traumatic for people to lose jobs in the past or switch jobs in the past. Millennials do it all the time. They'll work somewhere for a couple of years so they can go out and buy the car they want or the house they want, and then they'll switch jobs, and they're cool with that. So they're playing the system pretty well as far as I can tell. So here I'm going to pause, because one of the things that the corporations have done with that profitability is the buybacks, which in turn has clearly been a driver of wealth inequality. But I will defend the buybacks, because it's not the buybacks that are the cause of the wealth inequality. It's the cause of the buybacks that is the cause of the wealth inequality. So, if we're really going to look to drive the growth of the middle class ever again, we're going to have to see higher wages from the bottom up and the middle out. And till that happens somehow, we're going to have to face the reality that buybacks are a big deal. They're going to keep happening. And, when you have people like Bernie Sanders and Elizabeth Warren talking about how we have to limit buybacks, it's just, they're looking at the problem from the wrong angle. You need to raise wages from the bottom up and from the middle out, and there are mechanisms to do that without even changing laws. You just have to regulatory things. So maybe they do it, maybe they don't. Maybe they screw up and they limit the buybacks, in which case money will get wasted really much. So we have to keep an eye on that as citizens. So what are some of the major issues with the automotive layoffs? Well, what we're seeing in the automotive industry is that President Trump telling Mary Barra that she has to reopen that Ohio plant is, again, a politician not going to the heart of the issue. The reality is that there's major things happening in the automotive market that are driving the layoffs, and it's going to drive a lot more layoffs. And it's probably going to drive bankruptcies in the internal combustion engine automotive makers that are going to be rather profound. So the demand for internal combustion vehicles is about to be hit by this triple whammy. The first one is that we've had this huge cyclical rebound, right, after the Great Recession and cash for clunkers. So we've seen auto sales chopping around, but, that's a clear plateau, right? Are we going to get a couple spikes here? Maybe, but I don't think so, and here's why. Because the replacement cycle, and in a society where half the people can't afford new cars, and that number's going up, the replacement cycle for cars is stretched out from about 3.5 years up to 5 years now for new car buyers. right? And that's significant. And the average age of a car has risen from about 10 years to 13 years by the time it's retired. And that's all happened in the last decade because of quality improvements and people trying to stretch those cars out because they just can't afford the new car. So what's going to happen down the road? Well, wait a second. There's another thing, right? Just one more thing is that there's clearly a waiting game going on for many consumers who are looking to buy EVs, right? Especially the millennials. So the millennials that I have come into contact with, they are for sure not buying a new car every 3 years, much less every 5 years. And if they have a car paid off, they're trying to stretch those out before they even sell them as used cars, because selling a used car, you never really get much back, right? So, they look at it from the standpoint of, okay, what's this worth if I sell it, but what is it worth if I keep it? And what they save in payments every month, $400, $500, $600 a month in saved payments, is worth way more after a year or two than turning around and selling a car for $5 or $10 grand. So there's this waiting game going on. So the combination of cyclicality, wealth effects, the waiting game for EVs, and the potential for economic weakness in the next year or two is really going to make it difficult on U.S. and global car makers. So the legacy car companies, General Motors, Ford, Chrysler, I think face a very daunting task of upgrading factories to produce EVs and or hybrids. GM's decision to close the Cruise plants in Ohio, just a symptom of that. It has nothing to do with, oh my God, I don't want to produce in America because it's too expensive. No, it's, I don't want to make these cars because we don't make any money on them. They were selling pretty many Cruises, pretty popular car at that price point. But for GM to make money, they would have had to raise the price about $1,000, and that would have helped. But it probably would have killed a ton of demand in a space for small cars, which is very price sensitive, hyper competitive, with flat to falling demand on top of that. So while the TSLAQ traders focus on the ramp up of Tesla and talking about how, they're not financially viable, I mean, they're about the only car company out there with growth. Toyota's right there too, with a little bit of growth, but Tesla is growing fast. So most of their problems they can grow out of. Plus, Elon Musk has shown that he has no problem going to get money from investors. Everybody wants a Tesla gigaplant. Everybody in the developing world wants to avoid the pollution and the dependence on oil if they don't have their own oil. And we're talking about China and India there, right? So the two biggest consumers of cars, they don't want gasoline powered cars. So China just invested in Tesla by making a loan. I think eventually that loan gets paid off, in 2 years? It's not very long. And Tesla probably dilutes. So I don't see Tesla being a great buy right now. I thought that maybe they would have blowout numbers last quarter, but they basically were in line. The traders are saying that they missed. They didn't miss. They're basically in line. And they're also going to have to go through some more growing pains, but they don't have a terminal downward decline. Who has the terminal downward decline are going to be some of the gasoline powered and the ICE engine makers. And what they're going to have to spend, think about what Tesla has spent over the last decade, right? If you're a TSLAQ person, you're saying, oh my God, look at all the money that Tesla spent. Yeah, GM and Ford and all these other companies have to do the same thing too in the next several years. And they're doing it in the face of lower profits. So how are they going to handle it when they already have massive legacy debt, right? And pension obligations, at GM and Ford. So I think GM and Ford are going to struggle, and, we might see Chrysler get blown up again. So, keep an eye on those. If I'm a trader and I'm looking for a great short, I'm actually going to learn about how Chrysler and Ford and GM are trying to get through the next recession, because I think it's going to be really tough for them. Barra over at GM, I think, is probably the smartest CEO of the bunch, and you got a president who's telling her what to do. I mean, she's basically telling them to go pound sand, but the reality is that there's a lot of pressure on these companies. They have to maintain optics, and going into the next recession, you might see some reorganizations. So the last part of the article that I'm writing right now has to do with the employment in the energy sector. So back when I told you to start buying these oil stocks again after the big correction, and I said the oil's probably going to $80 a barrel, it's and now Brent's over 70 already. What was that, 3 months ago? The reality is that the oil producers must have better cash flow. The banks are telling them, their shareholders are telling them. They can't be adding expenses. They have to find ways to increase margins. How can they do that? Well, they're trimming all the fat they can, everything they can around the edges. They've laid off over 10,000 people now this year. These service companies are a coin flip. Some of them are doing well short term. Other ones are probably going to go out of business. Somebody asked me about Schlumberger over at FA Trader, and I wrote a little poem for them. If I can find it, I will show it to you. Let me see here. A couple people liked the post quite a bit. Let's see here. Let me find SLB. Oh. I can't find it right now. But somebody asked me about Schlumberger, and I wrote a poem in iambic pentameter, Dr. Seussed it, and basically told them that I don't want anything to do with Schlumberger. Oh, here we go. I will throw this over here for you just because I'm so proud of it. He asked me about Schlumberger, and I said, I do not like oil services in my house. I do not like oil services with a mouse. I do not like them here or there. I do not like them anywhere. I do not like oil services in my portfolio. I think they're all going into a hole. I would not put them in a box. I would not sell them. I would try to sell them like a fox. No oil services in my house. I'd rather see another mouse. All right, you can read the rest. But the reason for that is that day rates for the offshore guys still haven't gone up. And the financial system doesn't want to support many mega projects, which is where the big money is. So even offshore is trying to do as short a cycle as they can and constrain their costs. So that's limiting FIDs. On the big projects where the profits are, you still have them stacking up rigs. There's just not a lot of money in oil services. And that's really at the heart of why there was job losses in the oil sector at a time where, probably, we're going to have a bit of a oil problem here, and that by next summer if demand doesn't turn over, right? If we don't get a recession, we're gonna have some price push from oil. So we have to keep an eye on that. Now I hope that we find balance. I hope we find equilibrium. But what we should know as students of economics and investors is that normally we pass through equilibrium relatively quickly. We don't usually trend along the equilibrium lines. We usually go above, and then we go back below, then we go above and below, and there's a trend in a direction, but we don't really just hold equilibrium lines. We just don't do it. And that is part of Avi Gilbert's Elliott Wave, is we follow sentiment. We don't necessarily always make rational decisions. It gets very sentimental and emotional, not only in economics, but investing. So we are emotional creatures, and that is what drives a lot of the things that are out there. So not only are we going to see quite a few changes in the automotive industry, but the energy sector, I gotta finish writing this part, this last couple paragraphs, is that I think that probably the oil companies that are doing well will do really well, and the oil companies that aren't doing well just are never going to catch up. So there was an article 4 or 5 months ago, might have been 3 months ago, over on Bloomberg, I think it was, and it talked about how there were only like 7 E&Ps that were operating out of cash flow. 7. Now, I showed a chart last week or the week before and included some other companies in the oil and gas space. There was like 18. That list will grow as the price of oil and gas go up, and the price of oil and gas are going to go up into the summer because OPEC is not going to increase production anytime soon. I would guess that they extend their cuts through the end of the year, through December, and we'll see what they do after that. But they're also, and Saudi Arabia is making this clear, Saudi Arabia is also going to say, by the way, and they've already said it twice, they're just going to keep saying it, by the way, we're going to drill more in the future, so you may not want to do that offshore stuff. So, you know, that's again, another reason I don't like oil service providers is the places where they make the most money just aren't happening. All right, so flew through that today, nice 30 minutes. What kind of questions do you have? And we might make this a nice 40, 45-minute one. Leisman is with one N. All right, I will correct that. Recommendation on 401k rebalancing. All right, so if you have been to my new Fundamental Trends website, shameless self-promotion, you will see that I have a 401k alert service for just $99 a year. But wait, there's more. I'm going to give a 50% discount on that in the next week or two when I formally launch it. I have been telling people to reduce their equity allocation this month in their 401ks. Not because I'm speculating on the correction, right? We've talked about the coming correction a couple of times, that there's an ambiguous setup right now in the markets where we could get one more leg higher before we go down to between 22 and 2600 on the S&P 500, 2200 being kind of that bottom level that I've shown in charts where we hit really strong support and institutions start to rotate, or we might turn over here later in the month. And money flow is kind of ambiguous as well. You know, are we going to get more money flow? Well, Trump is trying to talk up the China deal, and it sounds more and more like we're going to get the fake deal. You know, we're not going to get a no deal, but who knows? China could surprise us. But the fake deal, as I've defined it before, is very marginal improvements in trade issues. You know, for example, IP and enforcement. But they're going to buy more stuff in the short term. For example, energy. They've bought natural gas. You know, there's a deal with Cheniere that's not final. If the trade deal doesn't go through, Cheniere loses what, $48 billion of revenue over the next 10 or 15 years, something like that. I mean, there's a huge natural gas deal that would go through. And soybeans and semiconductors and other technology components. So, you know, let's see if we really do get the China deal. I hope we do. It would be all those marginal improvements that I talked about a year ago, which should be the ultimate goal, because we know there won't be a real deal with China because they're just not going to change the way that they operate in that country. Not going to happen. You can ask them, they're going to say no. You can ask them again, they're going to say no. You can ask them 10 billion times, and they're going to say no. All right, so other questions. I think Ray Dalio is a pretty smart guy. I think Jamie Dimon is a pretty smart guy. I think that Ray Dalio probably should be listened to a little bit more than Jamie Dimon, but both pretty smart guys. Some essay writers are noting the shortage of heavy crude. Yeah, a lot of I haven't written a lot on Seeking Alpha in the last month. I think I've written one article. Yeah, HFIR, they basically are always a week or two behind me. Things that they're saying now, I said months and months ago would happen. Now they're happening, so they're reporting on it. That's one thing that you got to keep an eye on. A lot of these guys who write a lot, they're not telling you anything new. They're just reporting on stuff. You can get that information on the Financial Times or Wall Street Journal or Bloomberg. I read all three every day. So that's not, there's a lot of regurgitation. Avoid the regurgitation. Go to the Financial Times, Bloomberg, or Wall Street Journal. You get better information, better graphics, really just better insights than the regurgitators. There are some really great analysts on Seeking Alpha, but avoid the regurgitators. Who cares what they say? They're just repeating the news and getting paid a penny a click. People ask me about the same companies over and over again, and I will tell you, I have talked about Encana over and over again, and there's nothing that's changed. Nothing. It's a company that if the price of oil and gas go up, like should happen going into summer, not only because of demand and tightening supply, because takeaway, right, the pipelines are going to get better. Same story, hasn't changed. So demand goes up in the summer because of drive season. Supply of oil is coming down because OPEC is making that happen, and the heavy crude is, you see that disparity between WTI and Brent. It's happening, and the light sweet, I think some of that's going to go towards the shipping to the ship fuel starting later in the year, and that's higher margin refining goods. So that's why I like Marathon Petroleum among the refiners. Phillips is okay too. Am I trimming January 2020 leaps? Not yet. Not on energy, not yet. I think that's coming in the next few months. I have trimmed proportionately most of my other holdings. Right? I'm not saying, well, I'm going to sell this one, but I'm going to keep this one. No, I mean, I'm up 20, 30% or whatever on some of these tech stocks. I'm trimming out the gains and then maybe 20 or 30% of the principal. So I would tell you that I think you should be up to around 25% cash again. And if this rally gets another leg, ramp up your cash even quicker. So whether it's a 401k, you're stuck in some of those crummy funds. Maybe you're at 50% cash now. I told somebody that this week. But if you have a portfolio of stocks and you understand what your stocks are, you studied the actual companies and you understand those businesses, then some of those you maybe hold on, you hold through some choppy markets. So it really depends on what your philosophy is on trading your portfolio. Do you want to just ebb and flow trade, maybe 25% of your money, or do you want to make very significant asset allocation changes where you can get to being 75% in cash once in a while? I don't get 75% cash often. It's been a decade since I've been at 75% cash, but I can foresee that happening at some point in the next year or two, maybe real soon, right? If money flows turn over in the next month, like they normally slow, But a fake deal with China would probably keep things from really turning over, and we get a leg up in the stock market. If there's a no deal with China, if President Xi is able to get the deal he wants, and he's really the one that's in control. President Trump's not in control of this negotiation. President Xi is. And anybody who thinks differently just doesn't understand the fact that President Xi is president for life, basically. President Trump is president for 2 more years if he loses in his reelection bid. So President Xi really holds the leverage here. And they stimulated their economy. They had a big comeback economically. Their data was good after they did some stimulus, and they can stimulate a lot if they really want to, a lot, right? Because they were a creditor nation for a very long time. So net debt, China's really, basically even. They don't really have any net debt because you take a look at the fiscal surplus on the federal side, and then you subtract out the problems with the municipal governments and the state-owned corporations, and it's kind of a wash. So, who says that they can't print money? Right? We print money. Why can't they print money? And they will, especially if they do it internally. I mean, the one thing with modern monetary theory is that until outside creditors come for you, you really can print money. And they would like to keep their exports strong until they're more of a consumer-based economy. So they're probably not going to drive the yuan up much in the intermediate and short term because they want to keep getting their exports and they want to transition to a consumer-based economy. But at some point, 2, 3, 4, 5 years out, you're going to see some changes, right? So they're going to gradually become a more international currency. They're gradually going to become more consumer-based, and then that'll change the dynamics of China. So, we want to be on the right side of China. I like the idea of having a very strong dollar. I don't think we should be competing for exports on price. I think anybody who's in business understands that if you compete on price, you become price dependent. You should compete on quality and service. And if you compete on quality and service, you're much, much better off than you compete on price. I would rather be a gigantic Switzerland and have a strong dollar for the rest of my life than I can travel anywhere I want and get, lobster for $5. All right. Upside. I think Antero had a unique situation. I have said this before. A unique situation where some people who were involved with the IPO cashed out, and that has happened in other companies where people who got in for $0 or for $1, were able to cash out at 9 or 10 times their money. It brings the stock price down 50% when they're cashing out, but that just means that it's now set up to double. Lyft IPO, I said all along that I think Lyft and Uber are overvalued by a ton. I think the fact that they can't turn a profit despite screwing their labor is very telling, right? So if Lyft and Uber can't turn a profit despite screwing the drivers, what does that say about them? And what happens, and I think this should happen and probably will happen, what happens if there's a law that gets passed in the United States that any commercial vehicle must have an attendant? It might not have to be a driver, right? The car might drive itself or the truck might drive itself. But what if they say that you have to have some sort of an attendant? Take a look at this, and we can find in transportation how many truck drivers are there. Transportation equipment, warehousing, truck transportation. Is that 1.5 million? Thousands. 1.5 million truck drivers, right? And I don't think they break out taxi. I would imagine there's more taxi and Uber and Lyft drivers than there are truck drivers. I'd have to check that out. But are we really going to put several million people out of work that are drivers now? That wouldn't be good. How about SunPower? I think SunPower has a chance to go to 100. I've said it before. I'll say it again. Industries that are growing at 20 and 30% clips, and they've had half of the industry wiped out because of competition and just the way that early industries are, the survivors end up becoming very big winners. First Solar is going to kill in the utility space. SunPower is going to kill with commercial and residential developers and contractors. The money is huge. So if they can go asset light and be a supplier and an advisor and create turnkey solutions, you know, I know a guy here he lives on the same block as me. He owns a roofing company. And he's like, yeah, at some point I can see that we're going to be putting up all sorts of solar installations and we're preparing for it now. Right? For years, these guys are like, nah, just give me my tar and my shingles, you know, but, you know, they're getting to the point where they're like, you know, we have these relationships and these people are going to want solar power at some point for the flat top buildings and new construction homes. You know, I've never been a big believer that existing homes are going to get a lot of solar just because they're not, you know, they're not facing the right direction. They don't have the right pitch, but new construction and the law change in California is a harbinger of this, are going to start getting that. So 2020 is going to be big for solar. I think solar is just going to be massive. The batteries are almost there finally. And 3, 4, 5 years out, you know, the markets anticipate. So if the smart money knows that the batteries are coming, they're going to start piling into these stocks. Then you'll get the FOMO thing, and, you know, maybe SunPower should only go to 50, but it'll go to 100 anyway. I don't know anything about Callan. All right. We'll call it a day. 40 some odd minutes. So weird, so weird. All right. Again, I recommend FA Trader if you want an add-on service and a nice platform for chat. Fundamental Trends is up and running. I'm going to start handing out the discounts. So follow me on Twitter at Kirk Spano or over on Facebook even. But I'm going to put some discounts out there to maybe the first 200 people, something like that. But FA Trader is a great add-on because then you get, you know, 10 voices. We just added a crypto guy who I met in New York, and he's real smart. So, you know, follow me around. Margin of Safety Investing if you're a retiree or near retiree. That's where that's geared. So that's a great place too. All right, everybody have a great weekend. Bye.